What's going on, guys? It's going to be day 5 of liquidity. So we are going to go a little bit more. I'm sorry, not day 5 of liquidity, day 5 of the bootcamp. We're going to be going more in depth into liquidity, though. There was one concept that I touched on in particular that I want to go more in depth on and make. I feel like it should be a whole video about it because it's just so important. I use them for pretty much all of my entry models. So let's get into it. What we're going to be talking about during this video is going to be liquidity sweeps. Now, if you haven't watched liquidity, that video that I made in the bootcamp, probably I think it's like 2 days ago, day 3. Watch that first because you're not going to understand what we're talking about if you don't know what liquidity is. Let's get into it. So, liquidity sweeps. What are liquidity sweeps? We know first, before we get into liquidity sweeps, we need to understand what liquidity is. I went a lot more in depth in that other video, so watch that, but I'm going to go over a brief touch on it here. Liquidity is simply resting orders in the market. All right. So when we're looking for where liquidity lies, we went over this already, but it lies at highs and lows. People place their stop losses at highs and place them at lows. So liquidity, their orders, their stop losses, their take profits, their entries, their whatever are at those points of interest, the highs and those lows. Now, certain highs and lows hold more weight, like we went over in the other video. Session highs hold more weight, previous day high, previous day lows. Session lows hold weight, data wicks, equal highs, equal lows, etc. These hold more liquidity, but regardless, there is still liquidity lying at these highs and lows. Now, do we hit every single one ever? No. Sometimes we don't need to. Whatever. Sometimes they get left, and then those people will make money or whatever. But more to the point, the market will target these highs and lows. There's a beautiful example of it right here. There's a 5-minute low. We come down, liquidity sweep, swept out this low. We swept all of this liquidity on the way down. So here, hit this liquidity, hit this liquidity. So swept this low, and then finally, once we swept this low, we reversed off of it. So in this example, let's say I am, let's say I'm entering right here, right? Let's say I'm placing my stop down here. I'm targeting, let's say, a 1-to-1, so right up here, right? I'm looking right here for market to go higher. I'm going to place my stop at one of the lows because if I'm expecting it to go higher, I'm not expecting it to keep going down. If you have it all the way down here, which you technically could, you'd be risking a ton of money to make very little money, which is stupid. People typically will go for at least a 1-to-1. But just as an example here, people will place their stop losses below lows, like I said. So this low right here is what we're using. What the market will do is it will come down, it will stop out people at these lows. So let's say in this example, I'm using this low, but there's other people who will be, they'll use this or they'll use here or they'll use whatever. But the market will come down and it will take all of that money to then use that money to fill orders by sweeping this liquidity, taking all the money, stopping all those people out. So now I'm stopped out. I lost my money, whatever. What the market will then do is it will use that money to fill big banks and institutional orders to then push price higher and push it in the other direction, right? So they're using my money. Now I'm out of the play. I miss out on the long, whatever. They'll use that to then reverse price in the opposite direction to then distribute towards whatever the next draw on liquidity is. This happens on every time frame. It happens all the time. I can go on the 15-minute, same liquidity sweep here, but I mean, even if I go over here, liquidity sweep, this low, swept out this low, that's a liquidity sweep. Same thing for this right here. These were actually all like relatively equal lows. If you don't want to call them equal, you can call it LRLR, which is low resistance liquidity. But yeah, so this happens on every time frame. It happens all the time. It is a regular part of how the market moves because, like I said before, nobody can win in the market without somebody losing. So somebody has to lose money. So what the market will do is it will go and it will target these points of interest where people have their stop losses, like right here. I'm going to look at this. This was just a 445 low. I wasn't sure if it was like a key low or anything. That's why I was checking more. But like here, this is Asia low from that day. So price came down. Price opened at, wow, this looks weird. Wednesday, Thursday, cool. So price opened right here. We rallied higher. We came all the way down targeting this liquidity because so many orders were left down here that the market wanted. It targets liquidity. And when too much liquidity builds up at one point, that's why equal highs are such a strong draw on equal lows, because Now, not only did you leave all the orders that were at that initial high, now you have a second high that people will also use as an anchor point, which is just like a double draw on liquidity. So it is a significant draw. Enough liquidity was built up here from Asia low. From that low, we probably have a gap here. This 4-hour gap right here. It's probably, maybe I'm wrong about that. I am. Regardless, what the market will do is it will target these areas, and this is called a liquidity sweep. So market takes out all the people who had their stops right here, uses this area, which is also a fair value gap, to also fill more orders, because like we said, price will retrace to fair value gaps in order to fill more orders. So that's not only one confluence, which is liquidity sweep, it's two, which is a fair value gap. I'm pretty sure, no, I'm wrong about that there. There might be an SMT there. There might be other things there. We haven't gotten into what an SMT is yet, but just kind of understand that these confluences will build on each other, and sometimes when they overlap, those will be the stronger like trades. If you have a liquidity sweep plus a fair value gap, plus you have an untapped, London high and an Asia high right next to it, so there's equal session highs. That's an extremely strong draw. You use these puzzle pieces to build together kind of a narrative to then formulate your entry model to that area on liquidity, and that's how you make money. You find the area, you build the story. Hey, we swept out this low. Hey, we tapped into this gap at the same time. Hey, we're distributing higher right now. We just broke structure to the upside. That's the most basic model that you can find in the world. We tapped a fair value gap, liquidity sweep, break a structure, enter it, put your stop below the low. That's a model right there. If you really wanted to do it, and if you get good at using it, that's a model. Like, you need to use these puzzle pieces together to build a system. Because I can give you how I trade my system, but the thing is, when I was learning, other people gave me their systems. I took a piece here, a piece here, a piece here, a piece over here, and then at the end of it, I put together my model with my own tweaks that is very similar to a bunch of other models, but tweaked in a way that works for me and how I trade. Anyways, enough rambling. I'm going to go over a lot more identifying liquidity sweeps. So we have another one right here. We're trending up. We came up. We swept this high out, right? So all these people who were in shorts, here they saw, big candle to the downside. I'm going to get in shorts, right? Place their stop right here. Price comes up, stops all of them out, takes their money, uses their money to fill institutional orders to push price lower to the next draw on liquidity, which was down here in this case. Probably a 4-hour gap, which there was. Also equilibrium of this range, which would be right here, roughly there. Comes down, tags equilibrium, tags a 4-hour gap, whatever, and you use all these puzzle pieces and you build kind of a story. I'm going a little bit too in depth. I'm gonna go over more of these confluences later, but I'm just trying to show you how like my brain kind of will view the market, and it will utilize all of this to kind of create like almost like a story, and you use that story to figure out where price is going to go next. But liquidity sweep, okay, that's a lot of leftover liquidity. That's probably why we came all the way down here. We left these lows down here and a whole bunch of liquidity on the way. We came down, swept all of that liquidity, used it to reverse. This is on a 4-hour time frame, so higher. Every one of these candles represents 4 hours. This is probably like, this is June, and then we came down in August. So this is like a pretty big move. Anyways, let me show you some more sweeps. I want to go to a lower time frame though. All right, right here. Came up, took this high out right here, pushed lower off of it. Liquidity sweep. It's very simple. I'm not even going to go into describe look at the explanations from the previous examples. I'm just going to go over what they look like really quick and kind of rapid fire a whole bunch of them at you, and then just show where they're going. But right here, liquidity sweep. Swept this low, distributed higher. Liquidity sweep. Swept this high, distributed lower. Liquidity sweep. Swept this low, distributed higher. Right here, I'm going to go to the 5 because it's probably more obvious. I'm surprised we left that, but right here, internal liquidity sweep. I'm sorry, this high here. Leftover high, swept out those highs, stopped everybody out, took their money, distributed lower. Surprising. Okay. Liquidity sweep right here. Equal highs, took the equal highs, swept it, this high, swept it here, distributed lower. And there's all sorts of liquidity sweeps on low, like even right here. Like it doesn't even have to be a significant like a bullish candle in order for that high to be relevant. This is still a high. If I go down to like the 3-minute time frame or something, it probably is a bullish candle. But from the 5-minute time frame, you just see this. You came up, you swept out this high, we distributed lower. Like right here, this high came up, swept it, sank lower. Right here. Came down, swept out this low right here, distributed higher. Took out the highs. Came back up, swept out this high right here, swept it, distributed lower. Like it's all over the place. It's everywhere. I could go on any time frame and identify 1,000 of these all over the place. Right here. There's a low right here. Came down, swept the low out, distributed higher. Like, and it's all over the place, and you use these so often. Right here, equal lows, came down, swept out the equal lows, distributed higher. I use these on a regular basis to formulate how I enter trades, and I figured this was a really important video to make just so you can kind of see them. I would highly, highly recommend going in your spare time and going and identifying a bunch of these because they're a very, very important confluence. Right here, liquidity sweep, swept out the high, distributed lower. Like, it's on every time frame. It's all over the place. You formulate these to kind of understand, because you have to understand where the draw on liquidity is before you can enter any trades. If you don't know where the market's going or what you're targeting, what are you doing? If you're leaving, like, here, this is gonna be kind of my last thing for this video because I'm not gonna go too insanely into depth. Let's say there's a high here with liquidity. The line is just the liquidity. Let's say there's a low here with liquidity there, right? We're somewhere in the middle. Maybe I don't know, we're trending, we're here, there, we're somewhere right here. Right now, we're trapped in between two draws. So there's like two magnets going wherever, right? You have pressure from both sides to be getting pulled. Now, what will happen is when one of the sides, right, like let's say we're coming up here and then we come all the way down here, once we sweep out that one magnet and that one draw gets taken care of, what's left? We don't have two magnets drawing us both directions anymore. Suddenly, we have one magnet drawing us higher because we just took out the bottom magnet. So think about it like that. The bottom magnet is now gone. Now we're looking and we're just getting pulled up to the top magnet. You look for your entry model on the way up, and then you target that next draw on liquidity. It happens all over the place. It's really important to be able to understand it because, you don't want to enter a trade when you're trapped in between two draws anyway. So right here, this is two draws, right? Once this draw gets taken out and mitigated, now we're free to just target the other draw. All of those people who were going for the longs and are stuck in between that range, who didn't get bailed out by just a random candle going up and sweeping the high first, because if you're stuck in between two and you don't know which one's going to go, because you can't know exactly which way it's going to go, you can think, hey, it's probably going to go here, but you don't really know. So if you don't know and you allow the market to show you and you're patient and you wait, it will show you. It'll literally take out one of those draws, and then you wait for your entry model to the opposite draw, and that's a liquidity sweep. All those people, you're waiting for one side of the people to get stopped out, then you're waiting for the banks and institutions to fill those orders, and then you ride that wave to the other side. You're riding it with the banks and institutions rather than being the one who's getting stopped out, and that's what's really important to understand. So we're at our 15-minute time. I can't keep going anymore. Hopefully that was a clear enough video about it. But yeah, just go look at a whole bunch of examples of these and understand that they're really, really important to understanding how price works and where we're going to go. And I'll see y'all later.